Hey guys, welcome to the show. Today, Thursday, June 30th, 2022, last day of the second quarter of a calendar year. Welcome to the show. We appreciate you guys' support and coming along, watching the videos here. We have a lot of stuff to talk about today. But first, I want to thank everybody for supporting the channel, especially Greg, my friend Greg Manarino and his Lions, who've been so great to us since we've got the channel started. Welcome to all of you guys, and thank you for all of your support. I really appreciate it. A lot of news to talk about today. The markets today were really roiled up. I think that, there's just so much stuff going on. The stock market took a beating today again. That apparently now the S&P is down 21% for the year to close the quarter. It's the worst start in the stock market in more than 50 years. It's just a bloodbath, and it's going to continue to get worse as economic conditions continue to get worse as well. Not good news for everybody in the market. The bond market today, more miracles in the bond market. On a day of a bloodbath of a day where literally everything was down across the board today, the bond market defies gravity again, with the 10-year closing below 3%. Last time I saw it, there was basically 4 basis points difference between the 2-year and the 10-year. Now let me explain what that kind of means. Ordinarily in a bond market, the yield curve kind of just looks like this. The further you go out in time, how long they're going to borrow the money, usually the higher the rate's going to be to compensate for market and interest rate risk. When you have conditions like we are now, the yield curve, instead of looking like this, kind of looks the way it is today. It's kind of weird because you got the 2-year, which should be the starting point, and you got the 5-year, which is a little bit higher, and then you got the 10-year, which is 4 basis points higher than the 2-year, but less than the 5-year. So it's kind of got a weird hump, and it's an abnormal yield curve. It's basically flattening out, I think, before it inverts to give us the for sure sign that the recession is here and or coming or already here. It's just remarkable what's happening in this bond market. The Federal Reserve is raising rates, and at the same time they're doing that, the yield in the bond market's declining. I think there's a lot of money being pumped into that market. I think a very small piece of it's coming from our friends in Europe, where the ECB there actually has a negative interest rate, and they're threatening to make it from -0.5 to -0.25. So I think some of our friends overseas are buying U.S. Treasuries as a safety move out of the stock market, and they're going to get better yield there than they would in their own in the Eurozone. Metals today, not a good day. Gold market was down. Silver gets hammered again. I think some of this has to do with the options and futures expirations here at the end of the month. But I think a lot of this still is, again, market manipulation. I just don't think that in this environment, metals should be going down. Now, it'll be interesting now that we're past this expiration dates to see how the market, or the metals market at least, reacts over the next couple of weeks. I think we might see a little bit of a rally coming up. Oil, an ugly day in the oil market today. Oil, West Texas, down over 4%. Natural gas really getting slammed, down over 15% today. Again, I think a small part of this is due to options expiration, but a lot of this, again, is just some real crazy stuff in this market. I can't explain it. With all the, I thought I really knew my way around these markets pretty good, but what I'm seeing here over this past couple of weeks is just something that's literally unexplainable. The dollar holding strong. It's just under the 105 level. I think part of that has to do with, again, our friends in Europe with their negative rates. The euro has a negative, and the U.S., the dollar has a natural advantage. It's going to be stronger than the euro, and I think that's kind of where the dollar's where it is. Bitcoin, another tough day for Bitcoin today. It was down over $1,000. It broke that support number at 20,000, which was kind of where it was bouncing off of every time. Now it broke through that to the downside. We've been kind of waiting to see which way it would break. That 20,000 number, which was used to be support up until today, now becomes the resistance number. I think the next support line is down around $17,000. So let's see now which way it goes. If it can break back up through 20,000, I think that would be a good sign for a little bit of a rally. If it continues down and it breaks down below the 17,000 support, well, now we have to reconsider our positions on Bitcoin. Just the craziest time I've ever seen in the markets. The debt market defying gravity. I made a point to look today. And on the 15th of June, when the Fed announced their 3/4 point rate increase, I guess that the market had already factored that in pretty well, and the 10-year stood at 3.30. We saw the 10-year rise all the way up to 3.5, where all of a sudden it met this wave of money driving the rate all the way back down under 3%. This is an unnatural phenomenon, especially in the face of this promised 3/4 point increase coming up in July. So we have the yield curve flattening out. It's going to invert. Mortgage rates are trickling down a little bit, but if you're going down from 6% to 5 7/8, it's not enough of a move to really change the conditions in the market very much. House flippers. Our friends, you've seen TV shows about this now. It was literally a mania. People making a lot of money flipping houses over the past couple of years. I think what happens in a lot of these situations when you have these giant bubbles and you have these manias, I think our friends, the house flippers, may very well go the way of the year 2000 day traders. I remember back in the day when everybody was going to quit their job and just trade .com stocks and everybody was making money. It was dartboard time back then. And I'm sure some of those guys are still day trading, but I'm guessing the vast majority of the amateurs who thought they were going to beat the market consistently are back to having a job working like the rest of us. I think it's going to be the same with these house flippers. I think the professional house flippers in the market will do okay. I think the amateurs and the late arrivals to the dance are going to end up holding the bag, guys. I don't know if they're going to be able to get out of these houses. I think they're going to go the way of the dinosaur. Now, some other big news today. They announced this personal consumption expenditures. They call it the PCE, which is whatever the Fed uses to weigh inflation rather than the CPI numbers. This is what I call a new bullshit measure to mask the truth and to calm the sheep down so they don't freak out and everybody runs for the exit at the same time. This measure, what they do, in this measure comparing it to the CPI, it excludes energy and food, and it also puts much less weight on the cost of housing than the CPI does. So basically, the stuff that people don't need every day, food, energy, and housing, is how they're measuring this, and it was still up 6.3% year over year, which is obviously a lot higher than the Fed's 2% target. I think that it's just a hoax of a thing. I think it's when you see the CPI numbers coming out in July for the second quarter, it's going to be significantly higher than the 6.3%. I think we're waiting now for not the CPI, but the inflation numbers. I'm sorry. The CPI will be higher than the 6.3, and the GDP, all these acronyms. The CPI Consumer Price Index, which is what the Fed used to use, but now they're going by this PCE, will come in significantly higher. And we're waiting to see what the GDP numbers look like, because I believe that we'll have another quarter of shrinking, the economy shrinking, which will confirm we're already in a recession. And I was kind of looking through that a little bit today too. I found an interesting thing. They said that when you're in a bear market and it's accompanied with a recession, the average length of that bear market is 20 months, with an average decline of 40%. Now, we've already had a pretty good decline this year, but that 40% is just the average. It could be significantly more, it could be less. That's just the average number. So I think that once we're confirmed that we're in a recession, we can expect further downturns in this stock market. The Fed, I'm starting to have my doubts about the Fed here as far as their promises and what they're doing with inflation. They're promising a 3/4 point increase coming up in July. I think that they're going to have a little bit of fear of doing that because they saw the result of their 3/4 point increase this month. I think that the market, even though they're kind of supposedly pricing it in, I'm not seeing that reflected in the yield. So I think that if they went ahead and raised it 3/4, the market's going to react the same way it did it this month. And I think I'm having my doubts about them raising 3/4. I think they might shade it back down to a half or even less. We're already hearing people talking about when the Fed can start cutting rates again. People have grown accustomed to this basic zero rate environment, cheap money. Well, I'm of the opinion that era is over. And now people are going to have to learn to live with a little more within their means. Debt's going to be more expensive to obtain and carry. I don't see rates plummeting back down to where they were with 3% mortgages, at least not in the short term. I think that all the things we've been talking about since we started this blog, that Greg's been talking about, and a lot of other really, really smart people, all of this stuff is now, every day we're getting more confirmation that what we're saying is right, that we're on the right side of this. And remember, like I mentioned yesterday, guys, you guys are ahead of the curve here. So what you're knowing now doesn't happen for a little while down the road. So please take the measures you need to take to protect yourself. I wanted to just briefly answer a question that I've been getting a lot of in the comments. People are asking me, what is a defensive position? How do I get into a defensive position? And there's a lot of different opinions on what that means. In my world, it kind of goes like this. I'd be looking at consumer non-durables, especially consumer non-durables that pay a fat dividend, soap, food, stuff like that. I'd be looking at high-yield, blue-chip preferred stocks. A lot of those have dividend yields that are way higher than you can get in the bond market with way less risk. I'd have a little bit of a taste in gold and silver just to preserve the value of the portfolio in case the dollar does have the collapse that a lot of people think it will. I don't know about a collapse, but I think it's sure as heck going to retreat from 105 before all this is over. And the rest I would have in cash, keeping my powder dry, waiting for the opportunities that are going to present themselves through this recession, and especially when the recession passes and it's time to start rebuilding. So take time to protect yourselves, get yourself into a little bit of a defensive crouch here. You'll probably be glad that you did when this is all over. I'm sorry that the news in the markets today was so bad, especially with a great 4th of July 3-day weekend coming up here. So I wanted to close with a quick thing. So many of you guys have been so generous commenting and making suggestions. I thought we could have a little bit of fun in the comment section today. So I'm going to start a sentence and I want you guys to finish it in comments. It goes like this. I trust the Federal Reserve as much as I trust, and I leave it up to you to finish. I think we could have a little bit of fun with that. If you've been taking the time to read the comments, you people are so generous, smart, clever, know your way around these markets. I mean, in some cases, I think you guys know a lot more than I do. So I really appreciate all of you guys watching the blog, supporting it. As always, before we close, if you like the videos, hit like, share the stuff with your friends, especially the people who may not be as aware of you are of what's going on right now in the world. Of course, comment with the funny line about the Fed. Ask your questions, please. And if you haven't already, subscribe to the channel. We appreciate your guys' support. We'll be back again tomorrow for a wrap-up of not only the week, but the quarter. We'll try to keep it a little bit lighter than today's news was, hopefully. And we'll all be off for our 3-day weekend for the 4th of July. God bless each and every one of you guys. We appreciate the support, and we'll see y'all again tomorrow. Thanks.